Corporate debt is an important market. If a company wants to expand, innovate, or sometimes just survive, they may need to borrow money. Any problems in this market, and it's going to have some pretty big knock-on effects. Suddenly companies need to take cost-saving measures, defaults are going to increase, and that's going to cost people their jobs and have a major impact on the economy, among many other things. And there's a very real risk that this scenario could happen within the next few years. The amount of corporate debt, specifically bonds, is huge. In just the US alone, the amount of outstanding corporate bonds is worth $10.6 trillion, with $1.4 trillion in new issuance last year alone. Now, the vast majority of this debt is known as investment grade. That means the companies which issue it are more than likely able to afford their repayments. That typically means they pay a lower yield, which is also known as the interest payments. But a smaller amount of this debt is high yield, also known as speculative grade, and it's got a few other names as well. Now, these are companies where things are a bit uncertain. There's a higher probability that they won't be able to repay their debt. So, since they're riskier, they pay a higher yield due to the default risk and to attract investors. However, the companies within these categories aren't static. If there are changes in economic conditions, that could impact a company's ability to repay its debt. Changes like interest rates that make borrowing more expensive, weakening economic growth that reduces revenue and profits, and unexpected events like the collapse of Silicon Valley Bank, which can spook the markets. But despite the increase in defaults that we've seen, the corporate debt market doesn't appear to be in a panic at the moment. We can use the spreads of corporate debt against treasury bonds as a gauge of perceived risk, with a wider spread signalling more risk for corporate debt. So the spread did widen in 2022 at the start of the rate hike cycle, but this has narrowed since then. And this makes sense in light of recent data. Economic growth has cooled, same with inflation, and there are hints from the Federal Reserve of rate cuts this year, which suggest that lower borrowing costs are on the horizon. So has a corporate debt crisis been avoided? No, and it largely comes down to two factors: the future path of economic growth and interest rates. Whatever happens with interest rates over the course of the year will mostly depend on what happens with inflation. So far, inflation has been trending down towards the 2% target, but there are real concerns that the final parts could be a lot stickier. And if that's the case, rates could remain higher for longer, and this would butt heads with current market expectations, which could lead to an increase in yields as that becomes priced in. Higher yields obviously means higher borrowing costs. And yes, there is some irony here that many companies do increase their prices to account for inflation, and then some, which then causes more inflation, which will then increase their borrowing costs. Now, if inflation continues to fall and remains low, then it's likely that rate cuts will stay on the table, which will bring down borrowing costs. Then, looking at economic growth, GDP has actually performed quite well considering where interest rates are. However, the Federal Reserve does forecast growth slowing down, but avoiding a recession. So this is overall good news for companies because slower economic growth harms their profitability. The problem is, if interest rates do remain high, that could create a drag on economic growth and even result in a recession. So this brings us on to four broad scenarios. We have high rate hard landing, high rate soft landing, low rate hard landing, and low rate soft landing. So a high rate hard landing is basically the worst case scenario for corporate debt. Under this scenario, interest rates would remain high, which increases the debt burden, and the economy would be in a recession, which threatens their profitability. So that's going to make it really tough for them to refinance. For now, the Fed isn't predicting a hard landing, but the biggest risk to these forecasts would be if inflation remained sticky or began to trend higher again, forcing the Fed to consider further interest rate increases rather than cuts, and therefore creating a bigger drag on the economy. With a high rate soft landing, borrowing costs would also remain high, but companies may be able to rely on positive economic growth to help them through that. So for example, they may still be able to generate sales and profit compared to if they were in a deep recession. However, they may still have to make decisions that reduce costs by reducing spending, such as capex, cutting jobs, or selling equity as a means of financing. A low rate hard landing would mean that borrowing rates have declined, but the economy is in recession. This type of scenario is more common, and it creates a risk for companies looking to refinance since it impacts their ability to generate profits and investors move to less risky assets. Deep recessions tend to be a big factor when it comes to mass defaults, with the last three being the 2008 financial crisis, the low oil prices in 2016, and the 2020 pandemic. Now, although the Fed doesn't predict a hard landing, if it did happen, it's more likely to come with lower rates, since they may lower them to stimulate economic growth. Now, the markets are already pricing in several rate cuts this year, since inflation has slowed, although it's generally accepted now that rate cuts in March aren't so likely anymore. However, even if rate cuts do happen, interest rates may be lower than the past few years, but remain higher than pre-pandemic levels. And lastly, we have low rates soft landing. This is where rates decline and economic growth remains positive. This is the perfect scenario and the one that everyone is hoping for because it's unlikely to create the conditions for a major debt crisis. So that gives us 4 potential scenarios and what each of them could mean for corporate refinancing. However, we also need to factor in time, and more specifically, the maturity wall. This is where there'll be a lot of corporate bonds maturing, many of which will need refinancing, and if 3 of those scenarios, except the low rate soft landing, do happen during a maturity wall, that's when it's going to cause the most impact on the bond market. If they can refinance, no problem. But if they can't refinance, then there's a problem. And according to S&P, there's around $250 billion worth of high-yield corporate bonds up for maturity this year, compared to $100 billion last year, and it almost doubles again to $400 billion next year, and if we also include investment grade, that's over $1 trillion in 2025. Considering half of the publicly listed companies are unprofitable and creditworthiness has declined, there certainly is a big risk in the coming years, unless a soft landing scenario plays out.